Three things just happened. China's domestic silver scrap market spiked to the equivalent of $96 an ounce. Political trade rhetoric escalated again, with renewed tariff pressure and open frustration towards central bank policy direction. And COMEX open interest expanded aggressively, while registered inventory failed to rise with it. Most people will read those as separate headlines. They're not. They are pieces of the same macro equation. Because when Eastern physical pricing detaches from Western paper benchmarks, when trade policy uncertainty rises, and when leveraged futures positioning rebuilds at the same time, you don't get noise. You get structural tension. Here's what makes this different. Scrap markets are not speculative arenas. They are demand signals. Scrap only bids aggressively when real downstream buyers need metal immediately. Industrial users do not overpay for recycled supply unless forward demand visibility is improving. If internal Chinese pricing is clearing dramatically above Western spot benchmarks, that tells you something about physical tightness inside the supply chain. Now layer in trade rhetoric. When tariffs are threatened or expanded, corporations don't wait. They front-run inventory. They accelerate imports. They hedge supply risk. Metals are among the first inputs to be pulled forward, and that pulls pressure into warehouse systems quietly. At the same time, futures positioning is expanding. Open interest rising faster than physical inventory coverage does not guarantee a squeeze. But it increases sensitivity. It increases convexity. And when call options stack above the market in size, dealers hedge. That hedging amplifies moves. Most mainstream commentary is treating this like a retail hype cycle. It's not. It's a cross-border pricing divergence, meeting derivatives leverage under political uncertainty. By the end of this breakdown, you will understand why $100 silver is not about tomorrow morning, why the real story is inventory coverage and policy friction, and why the next 6 to 24 months may look very different from the last 6 years. Let's go step by step. Policy/government action. The first layer is policy friction. Renewed tariff threats are not simply political statements. They alter supply chain calculus immediately. When trade uncertainty increases, companies accelerate imports of strategic materials before tariffs hit. That creates temporary demand spikes. Metals, especially silver, are embedded across electronics, solar infrastructure, EV components, and defense systems. Silver is not just a monetary metal. It is an industrial input with limited substitution in high-efficiency solar cells and advanced electronics. If tariffs increase, landed cost of finished goods rises. Manufacturers hedge that risk by securing inputs earlier. That pulls demand forward. Simultaneously, political pressure around central bank policy creates another dynamic. If markets begin to price looser monetary policy expectations or fiscal expansion, inflation expectations rise before policy actually changes. Silver historically performs during inflation expansions, not necessarily during peak inflation, but during expectation repricing phases. Now combine trade acceleration with potential monetary loosening narratives. You create a demand front-loading scenario. Even if tariffs never fully materialize, the anticipation shifts behavior. Markets move on anticipation, not confirmation. And when physical metals are pulled forward in the supply chain, warehouse inventories begin to matter more than price headlines. Policy doesn't need to change dramatically. It only needs to create uncertainty. Uncertainty shifts inventory behavior. Inventory behavior shifts physical tightness. Physical tightness shifts optionality value. And optionality value is what futures markets price explosively. Corporate earnings/miner signal. Now look at miners. When large primary silver producers report earnings, they disclose realized selling prices. If miners are reporting realized prices above COMEX benchmarks, there are two possible explanations. First explanation: timing differences. Contracts priced earlier in stronger markets. Second explanation: off-exchange physical premiums. If realized prices are consistently above benchmark averages during the reporting period, that suggests physical buyers are willing to pay more for secure supply. Which explanation is more likely? In tight markets, physical premiums expand before futures markets react. Historically, we have seen this pattern in commodity cycles. Miners quietly report stronger realizations while paper prices lag. If that pattern emerges again, it suggests physical procurement desks are competing for limited, refined output. Remember, global silver mine production sits under 1 billion ounces annually. Industrial demand absorbs more than half of that. Investment demand fluctuates, but industrial usage is not optional. Solar capacity expansion alone has structurally increased silver intensity demand over the past decade. If miners cannot rapidly expand output due to permitting, CAPEX constraints, or declining ore grades, supply elasticity is limited. So even modest demand acceleration tightens margins. And when miners choose to sell forward cautiously, not aggressively hedge, that implies management expects higher prices ahead. Producers hedge when they fear downside. They reduce hedging when upside asymmetry increases. Watch hedging ratios. They often tell you more than headlines. Physical market evidence. Now we move to the physical layer. Dealer premiums. Shipping delays. International pricing divergence. If Chinese domestic scrap clears near $96 equivalent while Western spot trades far lower, that is not random. That indicates internal demand pressure. Scrap markets represent marginal supply. When marginal supply commands aggressive bids, it signals urgency. Additionally, watch retail dealer premiums. When premiums rise even while futures remain stable, it means physical inventory is tightening faster than paper markets reflect. Shipping delays compound this signal. Silver is bulky relative to gold. Logistics matter. If delivery times extend, it's often because inventories are not sitting idle, they are moving. Industrial buyers rarely advertise shortages. They quietly secure long-term contracts. But you can observe import-export data shifts. If imports rise sharply into high-demand regions, it suggests forward consumption expectations. International arbitrage normally keeps pricing aligned. When that alignment stretches, it means friction exists. Friction eventually resolves. Either physical prices fall back, or paper prices rise to meet physical reality. Historically, paper converges upward during tightening cycles. Derivatives/futures/options pressure. Now we reach the most misunderstood layer. COMEX open interest versus registered inventory. Open interest represents outstanding contracts. Registered inventory represents deliverable metal. If open interest expands significantly relative to registered stocks, coverage ratios tighten. Important clarification. Most contracts settle financially. Delivery percentages are small. However, the possibility of delivery matters when positioning becomes crowded. It increases sensitivity to unexpected delivery demand. Now, introduce call options. If large call positions sit above market price, dealers who sold those calls hedge by buying futures as price rises. That creates positive gamma pressure. As price approaches key strike levels, dealer hedging can accelerate price movement. This is not conspiracy. It is mechanical. If price rises into heavy call concentration, hedging flows amplify momentum. Now combine that with tight inventory coverage ratios. You create convexity. It doesn't require a full-blown short squeeze. It only requires incremental buying pressure during low liquidity windows. That's how metals move vertically, gradually tightening structure, then sudden repricing. Theoretical maximum squeeze scenarios make headlines. But the more probable outcome is sharp repricing phases, followed by consolidation. Volatility clusters. It doesn't drift smoothly. Connecting all threads, now connect the layers. Policy uncertainty accelerates inventory front-running. Front-running tightens physical supply. Physical tightness lifts scrap bids and realized miner prices. Miner hedging decreases as upside asymmetry grows. Dealer premiums widen. International price divergence expands. Meanwhile, futures open interest builds. Call option concentration increases above market. Inventory coverage ratios tighten. That is one unified macro structure. Not hype, not speculation. Structure. Does this guarantee $100 silver tomorrow? No. But it increases the probability of regime shift over the medium term. The silver market is small relative to global capital flows. It does not require trillions of dollars to reprice. It requires positioning imbalance. It requires physical friction. It requires narrative ignition. We are seeing early signs of all three. The next 6 to 24 months matter more than the next 6 days. Because structural tightening takes time. Then it resolves quickly. And when it resolves, price discovery can be violent. The key is not predicting exact timing. It is recognizing asymmetry when it forms. Right now, asymmetry is building, quietly, underneath headlines most people dismiss. Let's summarize clearly. Signal 1. Eastern physical pricing divergence, scrap markets, clearing dramatically above Western benchmarks. Signal 2. Trade and monetary policy, uncertainty, pulling inventory behavior forward. Signal 3. Minor realization data and hedging behavior suggesting tighter physical conditions. Signal 4. Expanding futures open interest relative to deliverable inventory, combined with stacked call option positioning. Individually, none of these guarantee a breakout. Together, they create structural convexity. What does this mean for the next 6 to 24 months? It means volatility is likely to increase. It means silver may experience sharp repricing windows rather than gradual appreciation. It means dips may become shallower if physical demand remains persistent. But we must also acknowledge risks. If global growth slows sharply, industrial demand could weaken. If policy uncertainty fades quickly, inventory front-running may reverse. If futures positioning unwinds before physical tightness intensifies, price may consolidate longer than expected. Markets are probabilistic, not certain. The thesis here is not inevitability of $100 tomorrow. The thesis is structural asymmetry. When physical and paper layers disconnect under policy friction, the metal with the smallest market size tends to move the fastest. Silver historically has that characteristic. Convex, underowned, volatile. This is not financial advice. It is structural analysis. Your job is not to react emotionally. It is to observe positioning, inventory, and policy alignment. If those remain in tension, the probability of significant repricing increases. If they fade, the thesis weakens. Independent thinking matters. Because by the time mainstream coverage declares a breakout, most of the move is already behind you. Right now, we are not in euphoria. We are in early-stage structural tension. That is where asymmetry lives. And whether silver reaches $60, $80, or $100, the real shift will not be the number. It will be the regime change underneath it. Watch structure. Watch inventory. Watch policy. The rest will follow.